You walk into a casino, ready to test your wits against the dealer or your luck on the slots. But your understanding of how money truly changes hands here could cost you a fortune. The casino is not just another player hoping to get lucky. It is a high-frequency, data-driven real estate business, mathematically engineered to take a slice of every dollar wagered. You assume the house is sweating the result of your next roll or the turn of a card. You see a vibrant, chaotic floor and interpret it as an arena where skill and chance collide. You believe your losses are just the casino's winnings, and that if you play well enough, you can bend the outcome to your favor. Yet this entire mental model misses the structural reality of the floor. Why does the house thrive when the volatility of individual games seems so wild? And how does a corporate entity turn that chaos into predictable financial performance? That predictability is not magic. It is raw arithmetic. The casino functions as an infrastructure play, harvesting a slice of every dollar wagered through the law of large numbers. Every game on the floor relies on a house edge, a mathematical advantage ensuring the house retains value over time, regardless of individual jackpots or losing streaks. In American roulette, that edge sits at 5.26%. For every $100 wagered, the casino mathematically expects to keep $5.26. Over thousands of hands, individual variance vanishes. The house does not gamble on a single spin because the probability curve is fixed. They simply own the floor, secure the capital, and wait for the volume to compound. Yet, if the house edge is this mechanical, why spend billions to keep you inside? This is not just about the game. It is about a hidden tax. That hidden tax lives inside the luxury room rate and the subsidized buffet price. You perceive these as perks, but they are precise customer acquisition costs, meticulously engineered to keep you on the floor. Every discount exists to extend your time on device, ensuring the math engine never stops spinning. This infrastructure serves one purpose: trapping you within the ecosystem. The gaming floor and the luxury resort are two distinct engines fighting for the same square footage of your attention. The floor is a retail engine designed for one primary metric: time on device. Every square inch of the carpet, the specific decibel level of the music, and the precise angle of the lighting exist to minute angle of the friction between you and your next wager. The casino is selling a high-frequency, probability-based commodity. You are not just paying for entertainment. You are paying a rental fee for the privilege of risking your own capital. By keeping the games fast and the exits hard to find, the operator ensures you remain in the seat long enough for the math to do its work. Yet, once you pull yourself away from the machine, you enter the second distinct business: the luxury resort. This is a captive real estate play built around the gaming floor. The rooms, the buffets, and the shows are not merely perks. They are strategic infrastructure designed to maximize the ecosystem trap. If you are eating, sleeping, or watching a concert inside the property, you are not spending your money at a competitor down the street. The resort captures the portion of your budget that the gaming floor might have missed. By integrating these two models, the casino creates a closed loop. The hospitality side lowers the barrier to entry, drawing you in with the promise of a deal, while the gaming side extracts the margin as you move through the building. The business depends entirely on this specific hierarchy of revenue. One side of the house creates the traffic, and the other side processes that traffic into a consistent, predictable flow of wagers. But there is a massive imbalance in how that money actually accumulates. While you might focus on the thrill of the cards or the spinning wheel, the vast majority of the cash is flowing from a different source entirely. What is the actual hierarchy of this revenue engine? And why do casinos guard the specific breakdown of their earnings so closely? Slot machines are the undisputed engine of this retail machine. In the typical American casino, these devices generate between 50 and 70% of all gaming revenue. They require no dealers, They run 24 hours a day, and they operate on a simple, immutable formula of speed and volume. While table games like blackjack or craps rely on a dealer interacting with a player, a slot machine is a standalone transaction point. It creates a perpetual loop of risk that requires no human labor overhead to initiate. This is why you see the floor layout prioritize them above all else. They are not merely games. They are the most efficient tax collection tools ever devised for a retail environment. The remaining gaming revenue comes from table games, where the income model pivots to the rake in poker or the house edge built into the rules of blackjack. Here, the house earns a commission on the total amount wagered, or it captures the statistical difference between the payout of a winning hand and the mathematical probability of that win occurring. Crucially, the casino does not base its survival on the outcome of a single day or a single high roller. Operators use a metric called the theoretical hold. This is the projected percentage of every dollar wagered that the casino expects to retain based on the specific math of the games being played. Because the law of large numbers dictates that results will inevitably trend toward this mathematical mean over thousands of cycles, the casino can treat its expected profit as a near certainty. They do not guess if they will make money. They calculate exactly how much they should hold based on the total handle moving through the floor. This predictability allows the casino to generate a quarterly earnings report that looks more like a boring utility company than a wild gambling den. The revenue engine is not restricted to the games. Modern resorts draw significant income from hotel bookings, dining, entertainment venues, and high-margin VIP membership programs. This non-gaming revenue serves a vital secondary function. It keeps the customer inside the building. The resort creates a closed loop where the money spent on a steak dinner or a hotel room is merely a buffer before the guest returns to the floor to pay their tax on every hand. This is the hierarchy of the business. Slot machines command the largest share, followed by the high-velocity table games, and finally, the supporting infrastructure of the luxury resort. When you total these streams, you see the gross potential of a regional powerhouse generating billions of dollars in revenue every year. However, the theoretical hold is only one side of the ledger. These billion-dollar revenue streams are anchored by a massive structure of operational costs that never sleep, regardless of whether the floor is empty or packed. The question that dictates the survival of the entire facility is how the fixed expenses balance against this revenue. To build a modern resort on the Las Vegas Strip, you are looking at a capital investment of between $2 billion and $5 billion. That debt does not care about win-loss variance. Every single day, the lights must stay on, the air conditioning must run, and the security teams must patrol the floor. The staffing levels alone for a facility of this scale reach into the thousands, creating a massive, immovable wage bill that functions as the primary anchor of the business. On top of the human labor, you have the game provider royalties. For major slot machines, the casino pays roughly $12,000 per month, plus an additional percentage of the winnings, just to keep the machines on the floor. Then there are the regulatory licensing fees, which, depending on the jurisdiction, can require an initial outlay of $60,000, followed by annual renewals exceeding $50,000. These are not costs that fluctuate with the win. They are the price of admission just to keep the doors open. If gaming revenue falls, these fixed operational costs do not shrink. They remain as a constant, crushing pressure against your margins. Every square foot of the floor is calibrated to justify its existence through consistent throughput. The casino is a machine designed to turn electricity, staff time, and square footage into a predictable flow of cash. But what happens to this machine when the foot traffic slows or the doors stop swinging? When you factor in the daily burn rate required to service billions in infrastructure debt, even a slight dip in player volume can turn a profitable quarter into a liability. The math is brutal, and the margins are thinner than you might suspect. The profit is not found in the static presence of the games, but in the relentless, rapid cycling of capital through the system. And that brings us to the real lever the casino pulls to keep its head above water. That velocity is the heartbeat of the entire floor. You see a room filled with people testing their luck, but the casino sees a high-frequency, continuous conveyor belt of discrete, repetitive transactions. Every second you spend playing is a second, where the house is collecting a fractional rental fee for the privilege of letting you risk your own capital. The floor layout is not designed for comfort. It is engineered for flow. It maximizes throughput by shaving every possible second off the delay between hands or spins. More hands per hour mean more opportunities for the house edge to do its mathematical work. They do not wait for you to come back. They build an architecture of convenience to ensure you never have to leave the ecosystem. This is where the complimentary buffet, the discounted hotel room, and the concert tickets turn into a calculated loss leader. These services function as a customer acquisition cost, a precision-tuned expense to keep you in the seat, paying that hidden tax on every single wager. If you leave the floor to sleep or walk to find a meal elsewhere, the revenue machine stops. So, they bring the world to you. They track every bet you make through your player card, building a hyper-detailed profile of your tolerance for risk. They know exactly how much they can afford to comp you before it cuts into their target margins. You are not being pampered. You are being audited in real time by an algorithm that views your presence as a data point. The goal is the absolute elimination of any friction that might interrupt the cycle of wagering. If the gaming floor is the retail engine, the resort is simply the infrastructure meant to anchor you there. It is a closed loop designed to maximize your time on device. While you focus on the outcome of the next roll or the next spin, the house is focused exclusively on the aggregate volume of those cycles. The individual variance of your wins or losses does not matter to a system calibrated for thousands of spins every hour across hundreds of machines. They have effectively turned the chaotic, human impulse of gambling into a high-frequency, retail-optimized machine. But that machine only functions if the math behind the wager stays strictly locked in the casino's favor, despite the staggering overhead of the physical plant. That reliance on sheer volume is what makes the business model so rigid. If we move from the general strategy down to the specific mathematical engine of the wager itself, we can calculate exactly what remains when the dust settles on a single bet. For instance, on a $100 wager, the casino, thanks to its standard house edge, expects to retain a predictable fraction of that capital. But how does that slippage compare to the much higher volatility and different return structure of a modern slot machine? And where do the massive, unavoidable costs of maintaining this physical space, the security teams, the armies of staff, and the non-negotiable regulatory compliance eventually push the business toward a breaking point? The gap between that predictable return on a single wager and the multi-billion-dollar reality of a strip resort comes down to the sheer velocity of those wagers. While games like roulette offer a static edge, slot machines rely on the machine return to player percentage, which is the inverse of the house edge. A game with a 4% house edge guarantees a 96% return to player, but that percentage is calibrated over millions of independent spins generated by random number generators. An individual player might experience high variance and hit a jackpot on their first attempt, but the casino is not betting against that person. It is betting against the aggregate. By increasing the speed of the game and the number of devices on the floor, the casino compresses the time needed for the law of large numbers to assert itself. Every square foot is optimized to increase the number of hands played or spins pulled per hour. The faster the money moves through the system, the faster the house edge extracts its slice of the total capital wagered. However, this high-frequency extraction machine is anchored by a brutal cost structure. A modern resort on the Las Vegas Strip, representing an immense capital investment, requires constant, high-volume performance to justify its existence. Operational costs remain constant regardless of the room occupancy or the number of players at the tables. Beyond the basic staffing requirements, which create a massive recurring wage bill, the casino must pay slot providers significant ongoing fees for each unit. Licensing fees for these systems can also run into the tens of thousands of dollars, depending on the jurisdiction. These expenditures are non-negotiable anchors that demand payment whether the gaming floor is packed or deserted. Beyond the hardware, the casino faces a complex web of regulatory compliance costs and security overhead designed to protect the integrity of the floor. Marketing and data-driven personalization campaigns attempt to lure customers back to the property, adding another layer of recurring expense meant to maintain the velocity of money. The danger to the model occurs when the gap between these high fixed costs and the actual revenue stream narrows. If foot traffic slows or regional competition intensifies, the house edge becomes insufficient to cover the debt service and the operational bleed. The business model assumes a consistent rate of throughput, and when that assumption hits a wall, the reality of the balance sheet changes overnight. You see how an asset designed to print money through the relentless math of probability can suddenly transform into a liability that cannot service its own infrastructure. This was the specific sequence of events that forced one of the most expensive and ambitious projects in Atlantic City history toward a total collapse. The answer is found in the wreckage of the Revel Casino Hotel. Opened in Atlantic City with a price tag of $2.4 billion, it was designed as a monolith of luxury. But for over 2 years, it failed to turn a single dollar of profit. The machine struggled because it relied on massive fixed infrastructure costs that could not shrink when the players disappeared. A bloated private power plant and expensive cooling systems created a high, unyielding burn rate regardless of the nightly room count or the actual volume on the gaming floor. These fixed expenses acted as a financial anchor, dragging the bottom line down even when the doors were open and the lights were on. The revenue mechanism failed because the regional market for gamblers was not expanding to meet the property's scale. When new sports betting legislation in neighboring Delaware allowed the region to pull foot traffic away, the casino could no longer sustain its high-volume dependency. In this industry, when the velocity of money drops, the property stops being an engine of profit and instantly turns into a massive static liability. The fixed costs remained constant, but the throughput vanished. The reality of the bankruptcy auction told the rest of the story. The resort eventually sold for $110 million, which represents about 4.5% of its original construction cost. That staggering gap between build cost and exit price is the ultimate indicator of an operational model that relies entirely on high-frequency churn to justify its existence. This collapse exposes the fundamental vulnerability of the casino as an infrastructure play. If you cannot maintain a constant high-speed flow of bodies, the billion-dollar concrete shell becomes a dead weight that drags the entire balance sheet into the red. You have a relentless demand for high-volume revenue just to pay the utility bills and the massive interest on construction debt. This failure provides the perfect baseline to see exactly how a successful property stays on the right side of the ledger. To understand the difference between a thriving resort and a bankruptcy filing, we must dissect a hypothetical profit and loss statement to see how the house maintains its grip when the gears start turning correctly, and why the variance in net profit depends entirely on whether the seats are full or empty. We can map out a standard year in the life of this machine, contrasting a period of high efficiency against the sudden, cold reality of a revenue shortfall. In a high-performing year, the machine hums in perfect synchronized rhythm, Take a typical $5 billion resort on the Las Vegas Strip. Its gaming floor is a retail engine designed for one goal: throughput. When the floor is crowded, that house edge works on a massive constant stream of capital. If 1,000 players move through the floor at 500 hands per hour, the cumulative impact of that embedded house advantage creates a reliable, predictable river of revenue. Even after subtracting the 50 to 70% of gaming revenue typically generated by slots, the house retains a significant margin of profit from that volume. The non-gaming amenities, meanwhile, act as a gravity well. Because the hotel, the buffet, and the shows are priced to keep the customer inside the ecosystem, the resort captures a second, distinct stream of income. Every dollar spent on a steak dinner or a room booking is a dollar that doesn't leave the premises, effectively recycling the capital already pulled in by the games. In this high-volume cycle, the fixed costs, the massive wage bill for thousands of employees, and the tens of thousands of dollars in monthly provider fees become thin fractions of the total take. The business is not gambling. It is a high-speed processing plant for cash. Now, consider the inverse. When the gears stop, the machine doesn't just slow down, it breaks. In a bad year, the revenue flow dries up, but the fixed infrastructure costs, the very backbone of that $2 to $5 billion construction investment, do not budge. The utility bills for a massive resort are constant, and the maintenance of that climate-controlled, air-filtered, high-security space is inescapable. When foot traffic drops below a critical threshold, the math shifts from profit to hemorrhage. You can see this in the forensic record of the Revel Casino Hotel. It was a structure built for a volume that never materialized. Its bloated power plant required massive, permanent overhead, and as regional competition increased, the guest counts evaporated. When the velocity of money stalls, the casino ceases to be a generator. It becomes a static, immovable liability that consumes its own capital reserves. The gap between these two scenarios isn't defined by the skill of the players or the luck of the cards. It is defined by the absolute necessity of throughput. If the doors aren't swinging, the entire mathematical edifice loses its structural integrity. The house might own the board, but the board requires a constant stream of players to function. The structure demands a level of throughput that makes the individual player result irrelevant. When you look at the floor, you are seeing a machine designed to convert square footage into a stream of consistent, fractional percentages. The casino operates on a simple, brutal reality. The house does not need to guess the outcome of a single bet because has engineered the entire environment to ensure that capital is recycled through the house edge as rapidly as possible. A gambler plays against the odds, but the casino plays against time. By minimizing friction through integrated resorts and maximizing the hands per hour, the house turns the chaos of individual luck into the predictability of a retail utility. This business relies on the law of large numbers to smooth out the variance, transforming human impulse into a balance sheet entry. This video is for education and entertainment. It is not financial, legal, or investment advice.